Welcome to The Explainer. So if you're a private business owner in Canada, you probably know the feeling. All that success, all that profit, it can feel a little trapped inside your company. Well, today, we're going to talk about a special account that's basically a key to unlock that wealth and get it into your own hands completely tax-free.
So, let's start with the big question, right? The one that every successful entrepreneur eventually has to ask. Your company's built up some serious retained earnings, which, hey, that's a great problem to have. But how do you actually get that money out of the business and into your own bank account without giving a huge chunk of it back in taxes? You gotta wonder, is there a better way?
And that right there is the core challenge we're tackling. It's what we call the trapped money problem. As your corporation grows, it's building up all these retained earnings. But that wealth is, for all intents and purposes, locked inside the company. Why? Because the second you try to pull it out for personal use, it gets taxed as dividends. It's a real headache. You know, it's a really interesting way to think about it. The markets, they go up, they go down, we can't control them. But our tax strategy, that's something we can control. And honestly, that's often where the most reliable gains are hiding. We're not talking about anything shady here. It's not about avoiding taxes. It's all about smart, long-term planning to minimize what you have to pay.
All right, so what's the solution? What's this key we're talking about? Well, it's a special kind of corporate tax account that lets you unlock that trapped wealth. And listen, if you own a private Canadian corporation, this is absolutely something you're going to want to pay attention to.
Okay, it's called the Capital Dividend Account, or CDA for short. Now, just to be clear, this isn't a bank account you can, log into online. It's better to think of it as a special notional account, like an official running tally that the CRA keeps on your company's books. And its one and only job is to track certain funds that can be paid out to you, the shareholder, with zero tax.
So why exactly is this tax-free? What's the catch? Well, there isn't one. The whole key is that the government sees a capital dividend in a totally different light. It's not income you've earned from the business. Instead, it's seen as you getting your own capital back, money you already put in. That's the crucial distinction. That's why it comes from this special CDA and not your regular retained earnings. And that's why it lands in your pocket without a single dollar of tax owing.
Okay, so that's the big question, isn't it? How do you get money into this amazing account? Well, the answer is probably not what you'd guess. Believe it or not, one of the most powerful ways to build up a CSDA balance is through permanent life insurance. I know, it sounds a little strange, but stick with me.
So, we're not talking about just any insurance policy. This is permanent life insurance. And the key thing about it is that it has this built-in savings or investment part. It's called the cash surrender value. And the really cool part, the CRA lets the money in there grow year after year without you paying any tax on that growth. It's kind of like a supercharged savings account, almost like an RSP tucked away inside your insurance.
And this type of insurance really comes in two main flavors. You've got participating whole life, which you can think of as the set it and forget it choice. The insurance company handles all the investing in a big, conservative pool, and you just participate in the profits. Then you've got universal life, which is for the more hands-on person. You get to decide where the extra money is invested, giving you more control. But the bottom line is, both of them give you that amazing tax-deferred growth.
Okay, so we've got the pieces of the puzzle, right? We've got the corporation, we've got the insurance policy, and we've got this special CDA. Now, let's put it all together. Let's look at the blueprint for how this strategy actually works to get you tax-free cash when you retire.
All right, here's how it flows, step by step. First, your corporation buys and funds a permanent life insurance policy on you. For years, the cash value inside that policy just grows and grows tax-deferred. Step 3, when you're ready to retire, your corporation goes to a bank and borrows against that cash value. Now here comes the really clever part. Because those loan proceeds aren't considered taxable income, they create a credit in your capital dividend account. And finally, that credit gets paid out to you as a capital dividend, 100% tax-free. It's a brilliant bit of financial engineering.
And the impact this can have on your retirement income, it's huge. Just look at this simple example. Let's say you want to pull $100,000 a year from your company. Normally, that's all taxable. But with this strategy, you could take $50,000 as a regular dividend and the other $50,000 as a tax-free capital dividend. Just like that, you've cut your taxable income in half. Think about what that does to your marginal tax rate. It means way more money ends up in your pocket, not the government.
But wait, it gets even better. The benefits don't stop when you do. This is an incredible tool for your estate plan. See, when you pass away, that insurance policy pays out its death benefit.
And that death benefit is also tax-free. So that money first pays back the loan we talked about, and then the rest, which can be a huge number, gets added to the CFDA. Why is this so important? Well, it gives your family a ready pool of tax-free cash to handle the massive tax bill that usually comes due on a business. It means they don't have to scramble and maybe even sell the very company you spent your life building just to pay off the CRA.
So when you step back and look at this, you realize it's not just some clever little tax loophole. Not at all. What we're really looking at is the application of a master principle of wealth, something that applies to absolutely everyone.
I mean, we all know about diversifying our investments, right? Don't put all your eggs in one basket. But this quote really hits on a deeper level of strategy. It's about diversifying the tax status of your assets. Think about it. Having different buckets of money, a tax-free bucket, a tax-deferred bucket like an RRSP, and a taxable bucket, gives you incredible control and flexibility when it comes time to actually use that money.
And that really leaves us with one final big question to think about for your own situation. Are you just planning your investments, or are you actually planning your taxes? Because planning for when and how you pay tax can be every bit as important, sometimes even more so, than picking the right stocks. It's something to really chew on.